From Frankfurt to Brussels and beyond, Europe's financial institutions now find themselves caught between the competing demands of growth, regulation, and resilience. The picture is not one of sudden collapse or acute crisis, but of a sector that must carefully balance its stability in the face of new shocks, with the longer-term imperative to evolve and remain profitable. The reality is that European banks and financial institutions are navigating an environment defined not by a single overwhelming danger, but by a convergence of pressures that, together, threaten to reshape the very architecture of finance across the continent. One of the most striking recent developments is the decision by the European Central Bank and the People's Bank of China to extend their bilateral currency swap agreement for another 3 years. At first glance, this might seem a routine administrative decision, yet the symbolism should not be missed. By securing a liquidity backstop for Eurozone banks at a time of global uncertainty, the ECB is sending a clear signal that Europe intends to safeguard its financial stability not only through its internal institutions, but also through international cooperation, even with partners outside the traditional Atlantic order. The fact that this arrangement continues despite wider geopolitical tensions demonstrates both the pragmatism of central banks and the necessity of maintaining stable financial flows in an unpredictable global market. At the same time, the European Investment Bank, Global, has launched an innovation and green transformation facility aimed at the Western Balkans. This initiative is more than a regional development project. It is part of a broader European push to integrate environmental, social, and governance principles into finance, while also projecting influence and fostering stability in a strategically important region. The green transition is not merely a moral obligation, but increasingly an economic one. And by financing sustainable growth in Europe's near abroad, the EIB is binding together the imperatives of climate policy, regional integration, and long-term economic competitiveness. Alongside these initiatives lies the question of the digital euro, a potential central bank digital currency that remains one of the most contested subjects in European finance today. Advocates claim it would enhance efficiency, reduce transaction costs, and modernize payments infrastructure. Critics, however, warn that it risks undermining the traditional banking model by drawing deposits away from commercial banks, while simultaneously raising profound concerns about privacy and the potential for state surveillance. This debate encapsulates the broader dilemma facing Europe's financial system: how to embrace innovation and technological progress while protecting stability, trust, and the social contract that underpins money itself. The real problem, however, is not a single project or initiative, but what might be called the triad of regulation, risk, and return. European financial institutions are being forced to navigate this triad simultaneously, and their ability to succeed will determine the resilience of the entire system. On the regulatory front, the final implementation of Basel III rules is forcing banks to hold more capital, reducing their leverage, but also straining their profitability. At the same time, the Digital Operational Resilience Act, known as DORA, is introducing demanding new requirements for managing cyber risk and information systems. Compliance with these frameworks is vital for stability in an age where systemic risk can emerge not only from balance sheet weakness, but also from technological vulnerability. Yet it also drives up costs, absorbs management attention, and reduces flexibility at a time when agility is most needed. The second challenge is risk itself. Europe's economic outlook remains sluggish, with forecasts of only modest growth and persistent inflationary pressures. Higher interest rates, which once boosted net interest margins, now threaten credit quality, as businesses and households alike struggle with rising borrowing costs. Loan portfolios in sectors already exposed to downturns must be monitored with vigilance, while geopolitical instability and the rising sophistication of cyber attacks add yet another layer of uncertainty. Financial risk in Europe today is not merely about the old question of solvency, but about the fragility of networks, data, and trust. Finally, profitability pressures remain acute. The golden moment of higher net interest margins appears to be fading as central banks prepare to ease policy in response to slowing economies. Competition from fintech challengers and non-bank institutions is squeezing traditional banks from multiple angles. European lenders know that innovation, efficiency, and new revenue streams will be critical to survival, and many are turning to artificial intelligence and other advanced technologies to cut costs and expand services. Yet these technologies bring their own risks. The upfront investment is immense, regulatory scrutiny is increasing, and the integration of AI into financial decision-making could expose institutions to novel forms of bias, systemic error, or cyber vulnerability. Taken together, this triad of regulation, risk, and return leaves Europe's financial leaders in a position that demands careful strategy and clear vision. They must comply with more stringent rules while finding ways to preserve profitability. They must adapt to sluggish growth while preparing for shocks that could come from geopolitics, markets, or technology. And they must harness innovation while guarding against the dangers it introduces. What comes next will depend on choices made not only by banks themselves, but also by policymakers, regulators, and European citizens. Should Europe pursue deeper financial integration and embrace the digital euro, or preserve more traditional models of banking autonomy? Should banks be pushed towards ever stricter capital and cyber requirements, or given more freedom to compete globally? And perhaps most importantly, can European finance find a way to align profitability with resilience so that the pursuit of return does not undermine the very stability upon which trust in the system rests? In conclusion, Europe's financial system is not collapsing, but it is being reshaped before our eyes. The institutions that manage to navigate this demanding agenda with foresight, balance, and responsibility will emerge stronger and more trusted. Those that fail risk being overtaken not only by market forces, but by the technological and geopolitical shifts that are rewriting the very logic of global finance. Yet behind Europe's internal struggles lies a much larger drama: the transformation of global finance in the shadow of US-China rivalry. The renewal of the currency swap agreement between the European Central Bank and the People's Bank of China is more than just a technical measure. It signals that Europe is quietly preparing for a world where the dollar's dominance is no longer guaranteed, and where the renminbi might emerge as an alternative anchor for trade and reserves. Washington, of course, views such developments with suspicion, and the United States remains determined to defend the dollar's centrality through both market mechanisms and geopolitical leverage. Europe, caught in the middle, must decide whether its financial sovereignty is best served by closer alignment with its traditional Atlantic partner, or by a more balanced global engagement that includes Beijing. This dilemma connects directly to the issue of shadow banking, the vast network of non-bank financial institutions, investment funds, and credit providers that operate outside the strict boundaries of traditional regulation. Shadow banking has grown dramatically in both the United States and China, and Europe is increasingly intertwined with this opaque system. While it provides liquidity and flexibility, it also introduces fragility as risks build up in the dark corners of the market, beyond the oversight of regulators. In times of stress, these channels can amplify instability, as was seen during the 2008 financial crisis. The European debate on regulation, therefore, cannot be separated from the question of how to manage the cross-border flows and hidden risks of this shadow system. Adding yet another layer of complexity is the role of artificial intelligence in financial markets. Already, algorithms are driving trading, credit scoring, and risk modeling at a speed and scale beyond human comprehension. Proponents argue that AI will make finance more efficient, better able to detect risks, and more inclusive by expanding access to credit. But critics warn of systemic vulnerabilities, algorithmic biases that could entrench inequality, self-reinforcing market spirals triggered by automated trading, and cyber attacks exploiting the very systems designed to guard against them. In Europe, where regulation tends to move faster than in the United States, there is an opportunity to shape the global rules of AI-driven finance. Yet this requires both bold vision and the humility to recognize that no regulator can fully anticipate the unintended consequences of technologies evolving this rapidly. When seen together, these three forces, the shifting geopolitics of the dollar and the renminbi, the hidden power of shadow banking, and the disruptive potential of artificial intelligence, illustrate why the challenges facing European finance cannot be viewed in isolation. They are part of a wider transformation of the world economy, one where traditional anchors are being loosened, new risks are emerging in unexpected places, and the very logic of money, credit, and trust is being rewritten. The question then is not only whether European banks can survive the current triad of regulation, risk, and return, but whether Europe as a whole can position itself as a leader in the new financial order. Can it craft a model of finance that is stable yet innovative, open yet secure, profitable yet socially responsible? Can it steer between the gravitational pull of American financial hegemony and the rising influence of China, while carving out its own space as a normative and regulatory superpower? The answers to these questions will not be decided overnight, but the choices being made now, on the digital euro, on capital rules, on green investment, and on technology governance, will shape the trajectory of European finance for decades to come. And in that sense, today's incremental reforms may, in hindsight, prove to have been decisive turning points,